Hello and welcome to another one of our Macro Mondays. There was a lot going on last week and we saw some volatility at the index level and with some of the tech names and AI names at the end of the week. So we've got lots to talk about. So what created some of the volatility at the end of the week was that the US job numbers were released. Interestingly, they were weaker than expected, 142,000. Not to mention that there have been so many revisions after the fact as well. I think the market's starting to catch on to the fact that the 142,000 may actually be lower. So it's something definitely to look out for in the coming weeks. If there is a revision, it may end up lower than July, which there were a lot of situational examples of why that number was weak because of basically weather issues in the US through June and July. And now that we're into August, if this gets revised lower, I think that the market could be concerned with that event. So nonetheless, you can see a real trend downwards in terms of jobs created and potentially in the US. And we've seen the slowdown elsewhere, specifically in New Zealand. So we'll watch out for that. But in the meantime, weaker than expected. Moving on to Nvidia. Nvidia has had some issues over the last week. There were two catalysts for that. One is that Nvidia has been hit with a subpoena. They have been an absolute dominant force in the semiconductor space and eating up most of the demand, given that they're so far ahead of the GPUs. So naturally, the Department of Justice is inquiring whether there's anything shady going on there in regards to potentially how they are creating potentially artificial supply issues, which could also mean that they're driving their price up more than they potentially should. And then there could be some other antitrust activities or inquiries that they may have, perhaps to do with software layer, CUDA. But I think more likely than anything, it would be around artificial supply issues being created and then that basically allowing them to charge whatever they want. Nonetheless, we are starting to see this almost negative reflexive cycle starting with Nvidia. It's been an extremely volatile stock over the last couple of months, going up and down 20 to 30% on a regular basis without too many hiccups along the way. So difficult stock to be in, I would say long or short. And then Broadcom this week also mentioned how they believe that GPUs weren't necessarily the way forward. And instead, the CEO of Broadcom mentioned he is now becoming very bullish on the ASICs that are specialized for AI and training. So that is quite interesting how the Broadcom CEO is taking a shift in what he thinks the big winner will be and indicating that it may not be Nvidia from his perspective. So I encourage you to check that out. So September is seasonally weak and that has been consistent so far. Over the last 10 years, September only sees an increase 30% of the time. So notably the weakest month. I think it's consistent so far. However, I always get suspicious of these data points because they don't talk to what's going on in the moment. I mean, it's quite nice to have probabilities, but I wouldn't be making transactions or bets based on the fact that in a relatively short time frame, statistically, September is more likely to go down. And that's at an index level as well. So if you're trading individual equities, it's irrelevant. I think it's more of a talking point than anything super substantial, but an interesting data point. We know that this part of the year is often volatile. And actually out of the 20 largest one-day moves, 75% of them have actually happened in the second half of the year. So as you get through the year, you get people that, especially if you performed quite well in the first half, especially as a fund manager or an institutional player, if you're up 20 or 30% coming into September and there's volatility, you're more than likely to take risk off the table because you're wanting to protect your gains, you're wanting to protect your opportunity to make management fees, but not just management fees, performance fees. So if you're above the index, you have generated alpha, you're more likely to take a defensive posture into the end of the year and make sure you get a winning year. So from an institutional perspective, it does make sense, especially when you've had quite a strong first half. For the most part, I would say it's irrelevant if you're a long-term investor. What I wanted to talk about as well today is that when you get volatility, it's very hard to attempt to find safety. What you'll see from this one-year chart of the S&P, the Russell 2000, the NASDAQ 100, and the Dow Jones Industrial Average ETFs is that the correlations, they do break from time to time. You'll see here that basically the Russell did underperform for quite some time throughout the year and then played catch up. But what you do see quite clearly here is when these assets top out and then there's broad negativity and a bit of volatility to the downside, the correlations go to 1. So this is just talking about trying to be nimble and trying to pick the winners in a volatile market where potentially assets are just a little bit inflated and they need to come back into some normal range from a fundamental perspective and an evaluation perspective. When you get volatility, for example, recession happening, or what happened in Japan with the yen carry trade, these correlations basically go to one. So in that environment, everyone loses. And it's just important to note that when things get volatile, very hard to avoid that pain without just not playing the game. This was quite an interesting chart. This is the S&P 500 ETF and then the insurance ETF, the US insurance ETF, and then the financials ETF. So what we're saying here is financials and insurance companies are the real inflation hedge. And why is that? Well, that is because they have great pricing power. And as interest rates rose, they were able to drive their prices up. So insurance companies and banks have been making incredible amounts of profit over the last couple of years because as interest rates gone up, people's loan interest rates have gone up. And of course, in the case of insurance, you can't really opt out of insurance. You're not gonna just stop insuring your house or your car or your health. People probably, I guess, jump out of their health and their life insurance before they jump out of their house insurance because that's often a legal obligation if you own it. I mean, clearly that's an interesting chart. You look at the earnings of the insurance companies and some of the banks, especially the larger banks, and you go, wow, they've really printed money. I would say under the hood, though, I would be a little bit dubious of them. I think that companies with balance sheets that matter, which are financials, insurance companies, their balance sheet is really everything. You can get wild moves one way or the other, especially if there are losses and their balance sheet gets realigned with reality. For example, let's say you've got some real estate on your books that isn't actually doing great. The value of them are inflated on your balance sheet. You have an asset base on your balance sheet that's higher than it really should be. Once you take that action and actually write off some losses or have some delinquencies, your balance sheet can change quite quickly. So that's what has always made me cautious around banks in particular, but also insurance companies, is that when they have a tail event, then the equity of the company changes dramatically overnight. And it's very easy for an insurance company or a bank to blow up. Whereas if you're invested in software as a startup company that is a profitable business, it's very unlikely that overnight they go bankrupt. But that's just the game that banks and insurance companies play. But I think the point here is that, wow, they've had incredible earnings power. They've continued to just trek up, and they've actually outperformed the S&P over the last year and over the last 5 years. So probably better than gold, some would say. Okay, Berkshire. Berkshire are no longer a $1 trillion company. They were there briefly, but Berkshire were the first non-tech company to reach $1 trillion in market cap. So congrats to Warren and the crew. I think that since Charlie Munger died, and Charlie Munger is a hero of mine, I think they've added about $200 billion of market cap. I don't know what that says. If you would ask me when it happened or before it happened, what would happen if Charlie Munger passed away, I would have probably speculated that the stock should have gone down, but it's going up. It's tracking up. Now they've got a lot of insurance exposure, and they've obviously got that large position in Apple that is dramatically shrinking. So they've been taking profits at a good and opportune moment. And they have exposure to a lot of cash flowing businesses that are highly profitable with an emphasis on insurance premiums. So Geico and the like, a new position, Chubb, etc. So that it makes sense. It is an insurance company. It's not in the insurance ETF. I'm surprised by that. But yeah, let's see if Berkshire can claw its way back another $10 to $30 trillion and make it back to the $1 trillion club. Okay, so I talked about this in a recent episode that I've just recorded on Ways to Wealth, where I was actually being the interviewee, the guest, and I was talking about how if you've got 20 years left in your career and you're close to, or you've got a trajectory of getting to peak earnings, peak salary, you should be hoping for a massive drawdown in assets, because you have this, if you're disciplined and you keep your expenses low and you earn more than you spend, and that excess you can then buy productive assets and save, you have this incredibly long period of time where you can accumulate an asset base. So for people in their mid-20s to mid to late 40s with a long time horizon, you should be hoping for some volatility. And if that volatility comes, it could be an opportunity to really get aggressive and be frugal and get that dollar cost averaging really pumping. So at different periods in time, we like, as humans, little bits of dopamine and little bits of gains, consistent small gains. I think many people would opt in for because it's emotionally easier to handle. But actually, some volatility is good. And if you think about how many people benefited ultimately from the 2008 situation and actually 2000 to 2010 in the equity market, if you were dollar cost averaging into, for example, Microsoft or the NASDAQ through that 10-year period, it was ultimately down to flat through that period. And you would have been able to accumulate an interesting and large position. So for me, I've got a long time horizon. I'm hoping for some volatility because I want to be able to buy assets when they're cheap and when no one else wants them. It's a natural way also of those cyclical wealth transfers. Another note is that AI is pretty poor at creating images. The humans in the images always seem to look the same hairstyle, same laptop, always with these coins as well. And then very bad at spelling. So this is from OpenAI's image generator through ChatGPT. The amount of times I've got it to create a image and just all the spelling's wrong, or like much of the spelling is wrong, is funny. I don't know what they've done wrong in the algorithm to make it so in the image generation especially the spelling doesn't transfer from the text. Obviously I wrote the prompt had all the correct spellings for example low anyway, and they actually got base wrong. I did actually make a second prompt to say, hey, can you spell base right? And it did. But I've had this happen loads of times. It really shows you some of the holes and weaknesses of the models at the moment, how regularly they'll make mistakes. So just another anecdotal piece of evidence that LLMs and AI have a long way to go in terms of being reliable and better than humans. But it did save me time. It took me like 20 seconds to generate this image for this slide, so that's great. Anyway, I hope you enjoyed this episode of Macro Mondays. As always, none of what we mentioned in this podcast is a buy, hold, or sell recommendation of any type, or a recommendation to buy or obtain any assets or investments. It's for informational and educational purposes only. We hope you tune into the next episode, and we'll see you soon. Goodbye.